Okay, welcome everyone to a new deep dive. We've got quite an interesting one today. We're digging into a recent analyst report focusing on a company called Thejo Engineering Ltd.
Mhm.
And this isn't just a surface glance. The report really takes a close look at their recent performance. It specifically zooms in on a really crucial part of their international business, particularly in Australia, and tries to gauge what's coming next.
Right.
So our mission here, we're going to try and unpack this report for you, pull out the most important bits, and help you understand what's really driving the analyst's perspective and, frankly, why it might matter. We want to get to that core story, the key numbers, and the potential upside they're seeing, straight from the source.
Okay.
So let's start with the basics. What kind of company is Thejo Engineering? The report places them firmly in the industrial solutions space.
Yeah, think heavy industry.
Exactly. They focus on components and services for things like conveyor belts, mechanical power transmission systems, the kind of critical gear needed in big industrial operations.
Really essential stuff.
Absolutely. And they serve some major sectors, too. Mining, steel, cement, power. The report emphasizes they're known for high-quality services and products. Things like maintaining complex conveyor systems, supplying durable mill liners, filtration spares.
All pretty specialized.
Very. And the source actually describes them as a trusted partner, known for reliability and efficiency, which is key in those demanding fields.
hmm And this report, it really has a core narrative, doesn't it? It's very focused on their Australian operations.
Right, the Australian story.
Yeah. See, the challenge going in was that the company's overall FY25 results, consolidated, were actually a bit weaker than expected, and the report points the finger primarily at a tough environment in the Australian mining sector. That really hit their subsidiary Theo Australia PD Ltd, especially during the first 9 months of the fiscal year.
Okay, so Australia was a bit of a drag for most of the year then.
It was, yeah. But, and this is where it gets interesting, and it's really the focus of the report, that same Australian subsidiary saw a surprisingly robust performance just in the fourth quarter, Q4 FY25.
Oh, really? After dragging things down.
Exactly. The numbers are quite something. For Q4 alone, Thejo Australia pulled in revenue of Rs 253 million. And, maybe more importantly, their PBT margin, that's profit before tax, it actually turned positive. 3.6%.
Wait, hold on. So after 9 months of being negative, they flipped to a positive margin in just one quarter. That feels significant.
It absolutely is, and the report makes a big deal of that turnaround.
Yeah.
Just to contrast, for the first 9 months of FY25, that PBT margin was negative 12.8%.
Wow.
Yeah, so going from almost minus 13% to over plus 3% in 3 months, that's a dramatic shift.
Definitely. What did the report say caused that?
Well, it attributes the improvement to a couple things. Firstly, a more favorable business environment, so things picked up externally. And secondly, strategic cost optimization measures that the company put in place, so internal actions too.
Okay, so the analyst sees this Australian turnaround as kind of proof of concept for their main idea about the company.
Precisely, that's exactly it. This improvement directly backs up their core investment thesis centered on the recovery of the Australian mining sector. They were basically betting on Australia bouncing back, and Q4 seems to give some, early validation for that bet.
Right.
And just to add a bit more context, the report also mentions commentary from Australian miners anticipating reopening facilities, plus talks with Chile potentially increasing the overall market size, the total addressable market, suggesting maybe more upside there.
Okay, interesting. So that Australian recovery is a really key piece here. Let's shift gears slightly then. How did that fit into the company's bigger financial picture? Looking at the consolidated numbers the report gives us. Because even with that earlier drag, Q4 FY25 consolidated results look, well, pretty strong on paper. Revenue up 8.8% year over year and a solid 13.0% quarter over quarter, hit Rs 1.5 billion.
Yeah, good growth there.
And EBITDA grew too, right? Up 10.6% year on year, nearly 17% quarter on quarter, reaching Rs 282 million. And PAT, profit after tax, jumped by 22% year over year and almost 16% quarter on quarter. Rs 152 million. The EBITDA margin also improved, 18.4%.
Yeah, and what's fascinating is how that Q4 strength, particularly with Australia turning around, really helped cushion the blow from the earlier weakness. It made the full year look, well, less challenging than it might have been otherwise.
Although, as you said, the report does confirm the full FY25 was still weaker overall because of those initial Australian problems.
Correct, that's the context. Strong finish, but weaker year.
But the report also flags their financial strength, doesn't it?
Yes, absolutely. That's a definite positive highlight. The balance sheet. They finished FY25 with a consolidated net cash position of Rs 625 million,
Okay.
which is up quite a bit from Rs 459 million the year before.
That's a healthy increase in cash.
It really is. Building cash like that shows, solid financial health, good operational cash flow, always a good sign. And the report also notes, on a standalone basis, profitability was driven by their services business and good cost management, reinforces their operational control.
Okay, so they tightened their belts, the environment improved a bit, especially in Australia, and it flowed through nicely in Q4. So with that positive Q4 momentum and a stronger cash position, what does the report see driving growth going forward?
Well, the report points to recent order wins as a clear sign of future momentum. They specifically mention orders for ball mill liners, key components from big names like Vale in Brazil and JSW Steel. That's about Rs 67.4 million.
Okay.
And crucially, that Australian subsidiary, the star of Q4, they also secured Rs 50 million in orders from two mines in West Australia, mill liners and spares again. So the turnaround seems to be translating into new business.
That's promising.
It is, and these wins feed directly into a growing order book. The consolidated order book was at Rs 2.1 billion as of March 2025. That's up from Rs 1.6 billion a year earlier in March 2024.
Right. A bigger order book gives more visibility on future revenue.
Exactly. It provides a bit of a cushion, a pipeline of work.
So based on all that, the Q4 turnaround, the order book, what are the actual projections? What does the analyst expect for the next few years?
They're quite optimistic, actually. The report forecasts significant growth between FY25 and FY27. They're projecting revenue to grow at a KGR compound annual growth rate of 15.0%.
Okay, 15% revenue growth.
Yeah, and EBITDA growth even stronger at 23.1% CAGR. And profit after tax, PAT, they expect that to grow at an impressive 28.1% CAGR.
Wow, nearly 30% said peak growth compounded annually. That's
Nice.
quite bullish. What about margins? Can they sustain that?
Well, the expectation is for EBITDA margins to be sort of stabilizing in the 16 to 19% range during this forecast period. But the report does note there's potential for margins to expand further as the company scales up. As they grow in different regions, get more clients, they can spread their fixed costs or overheads over more revenue.
Better utilization, yeah.
Exactly,
Yeah.
which could lead to, fatter margins down the line.
Oh.
And all this leads the report to frame the potential quite positively. They actually say the company could be on cusp of a long-term growth cycle.
Okay, cusp of a long-term growth cycle. That's strong language. So bringing it all home then, how does the analyst value the company based on this outlook? What's the bottom line recommendation? The report keeps its BUY rating, and they didn't change their target price. It stays at Rs 2,350. Now, compared to the last close mentioned in the report, Rs 1,901, that implies a potential upside of roughly 24%.
Decent potential upside there.
Yeah. How do they get to that number, that Rs 2,350 target? The report mentions it's based on a blend of valuation multiples, PE, and even EBITDA applied to their forecasts for FY27.
Right. PE is price to earnings. If EBITDA looks at enterprise value relative to operating profit, standard metrics.
But applied to FY27 estimates, so looking quite far ahead.
Yes, looking 2 years out. And what's interesting is they've applied a 10% premium over the company's historical 5-year average multiples.
A premium. Why?
Well, it suggests the analyst believes the company's future performance, driven by that expected growth and margin potential we talked about, warrants a higher valuation than its own history might suggest.
Okay, so they think the market might start valuing them higher if this growth story plays out.
That seems to be the rationale, yes.
Makes sense.
But, like with any investment case, we absolutely have to look at the potential downsides, too. What risks does the report flag?
Good point. Yes, the report does identify a few key risks. First one, no surprise really, is the inherent cyclicity of the mining industry. That's a huge end market for Thejo.
Right, booms and busts. Exactly. Their business can definitely be sensitive to swings in commodity prices and overall mining activity. Geopolitical tensions are also mentioned, always a risk for global businesses, potential disruption to supply chains, demand, that sort of thing. And finally, they note high employee costs as a potential challenge to profitability, something the company needs to manage effectively.
Okay, so mining cycles, geopolitics, and costs. Standard risks for this kind of industrial player, perhaps?
Fairly standard, yes, but still important to keep in mind given the positive outlook.
Definitely. So let's try and wrap this up. Putting it all together, what are the sort of main takeaways from this deep dive into the report?
Well, I think the core story here is really about how one key region, Australia, significantly impacted the company's full year results. First as a drag, then with that sharp Q4 turnaround, providing early validation for the analysts' recovery thesis.
Right, the Australian turnaround is central.
It is. And that turnaround, combined with the strong balance sheet, the growing order book, and those expectations of better margins as they scale, that's what really underpins the report's positive outlook and the BUY reading.
Yeah, it shows how analysts often look sort of beyond the immediate headline numbers to find those underlying drivers and potential turning points.
Exactly. It's about the story behind the numbers.
And that actually brings us to a final thought for you, the listener, to maybe mull over. It stems directly from what we've discussed, especially those risks. Given that the cyclicity of the mining industry is highlighted as a key risk, it's just part of their business reality, right?
Mhm.
How much weight should really be placed on a single quarter's turnaround in just one region, like Australia?
Mm.
What does that Q4 performance truly tell us, not just about that specific quarter, but maybe about Thejo Engineering's fundamental ability to navigate these unavoidable industry cycles over longer term?
That's a good question.
It's just something to consider as you look at analyses like this one. How sustainable is the momentum versus the underlying cyclical nature? Anyway, thanks for joining us for this deep dive.